Hey traders, Gavin McMaster here from Options Trading IQ, back with another video collaboration with bar chart. And today we're going to be talking about delta hedging, which is a very important topic. And certainly at the moment, with the market going through a correction, very, very good skills you're going to learn today. Just a quick reminder that everything discussed is for educational purposes only, is general in nature, and does not take into account your personal circumstances. So today we're diving into one of the most essential risk management strategies in options trading, and that is delta hedging. You'll learn what delta hedging is, why it's important, and how to implement it in your portfolio. You'll also learn how to use bar chart Excel to help you structure your delta hedges. So let's get started. Firstly, what is delta? Well, delta measures the sensitivity of an option's price to changes in the price of the underlying stock. A call option of a delta with 0.5 means that for every $1 increase in the stock price, the option is expected to increase by 50 cents. A put option with a delta of negative 0.5 would decrease in value by 50 cents for every $1 increase in the stock. So what is delta hedging? Delta hedging involves adjusting a position to offset the delta risk associated with it. And delta is just basically our price risk. The goal is to reduce the directional exposure while not giving up too much in terms of time decay and without having to sell the underlying stock or option position. This can be a great technique to use during times of market volatility when stocks are dropping fast. The importance of delta hedging. Delta hedging allows traders to reduce their directional risk, resulting in fewer large losses. You'll see in a moment how this can help during market corrections. The mechanics of delta hedging. The first step is to calculate the overall delta of the portfolio. Next, we might want to beta weight our delta. This could be important because a 25 delta position in J&J is not the same as a 25 delta position in Nvidia. Then we want to decide on our hedging instrument and strategy. SPY long puts or bear put spreads are the simplest. Let's look at an example. So here within bar chart Excel, I've set up a fairly simple portfolio. Basically, we've got a couple of sold puts in Nvidia. These are all for the September expiration. So 102 strike, a couple of contracts on Nvidia. We've got a sold put on Apple at the 200 strike, a sold put on Microsoft at 385, and a couple of sold puts on Coca-Cola at 67.50. And then we've also got just some stock position here in Wells Fargo and Tesla. Now, all this data you can bring in through bar chart Excel. And then here I'm just going to calculate the notional delta of the position. So basically what we do is we take the delta times the position times 100 because it's an option contract, and then times the stock price. This gives us our notional delta. So this is like having $7,860 invested in Nvidia. That's our current exposure based on the option that we have sold and the current delta. This notional delta is going to change up and down as this delta changes and as the stock price changes. Similarly, for the stock positions, the stock basically just has a delta of 1. So that's nice and simple. It's the same formula, just delta times our position, but this time we don't need to times by 100 and times the stock price. So again, that's how much we've got invested in that current stock at the moment. Same with Tesla, we've got 25 shares at 207. Now, one thing that people get confused on, this figure here, our notional delta for the option position, is not our maximum loss. It's just our current notional exposure, and it's going to change up and down, but it's not our maximum loss. So we do that for all our stocks, and we come up with an overall notional delta of 34,321. So that's our rough delta for this particular portfolio. Now, we've got some stocks in here like Nvidia with a very high beta, and Coca-Cola with a very low beta. So what you may consider doing is beta weighting this portfolio, which I've done here. We can bring in our beta, Nvidia 1.68, Coca-Cola much lower at 0.59. And now we've got our beta adjusted notional delta. So here we're looking at the Nvidia exposure. It's actually much higher when we take into account our beta. Apple also a little bit higher than the overall market. Microsoft has dropped a little bit. Coca-Cola, our notional delta exposure is a lot lower because we have a very low beta on that particular stock. Wells Fargo, Tesla as well. And that gives us our overall beta weighted notional delta, basically our beta weighted exposure to the market at the moment, about $45,000 on the long side. Now, if the market is dropping really fast and we want to add a delta hedge here, we can use our notional delta, or if you want to be a bit more technical, you can use the beta adjusted amount. So I've got some SPY options that I've brought in here. And first thing I'm going to do is I'm just going to take the price of SPY, which is 532.90, and I'm going to take our notional delta divided by the SPY price. So this portfolio here is roughly equivalent to having 84 shares of SPY. So if we wanted to completely neutralize the delta on this portfolio, we would need negative 84 delta on SPY. Now, it's never going to be perfect if we're using SPY to hedge a whole portfolio, because we could have our portfolio stocks are going up and SPY is going down. They're not going to move perfectly. If you wanted to delta hedge each individual position, that would be better. Obviously, that's going to be a lot more complicated and a lot more transactions. If we want to keep it fairly simple, we can do this quick calculation. SPY stock price, we take our beta adjusted delta by the stock price, gives us a delta of 84. So we can say this is our SPY equivalent delta. Okay, so there's a couple of ways we could delta hedge this. We could take just the stock or the ETF of SPY, and we could short sell 84 shares. Our beta, of course, is going to be 1. And there you can see our combined notional delta now is more or less hedged. As the market goes down, we're going to be losing money on our underlying portfolio, but we're going to be making money on our SPY short sale, which is going to offset. Again, it's never going to be perfect, and this is going to be constantly changing and moving, but that's a really quick way to hedge your overall portfolio. Another way to do it, if we didn't want to short sell the stock or the ETF, we could use put options. So we could buy some put options, 84 delta worth of put options. So let's take a look at that. So let's grab an 84 delta. We'll grab this one. $83 delta, close enough. If we buy that put option, we take our delta times our position times 100 times the stock price. And again, delta, beta of 1. Again, more or less completely hedged. Okay, let's look at one more example. Instead of buying one 82, 83 delta, maybe we want to buy two 42 deltas. And that's going to give us a bit more gamma and a bit more vega. So say we buy 2 of these options, again, almost perfectly hedged. So that's how you can really quickly use bar chart Excel to calculate your notional delta and then figure out what you need to do to hedge. So now that you know how to delta hedge, what are some of the benefits of delta hedging? Firstly, we're reducing the risk of adverse price movements. We'll have lower drawdowns during corrective phases. We can protect against market volatility. What are some of the risks of delta hedging? There are costs associated with delta hedging and frequent rebalancing in the form of slippage and commissions. Delta hedging also adds complexity to the overall portfolio, and delta hedging will never be able to eliminate all losses. I guess the other risk as well is if we fully delta hedge and then the market actually reverses and goes higher, we're going to be losing money on our hedges, and we're going to be worse off than if we had have not added the delta hedge. So in conclusion, in today's video, you've learned a little bit about delta hedging. You've learned some practical steps that might help you avoid big losses during the next market downturn. If you enjoyed the video, please like, comment, and subscribe. Thanks for watching, and have a great day.